What's up, builders? This is Raise the Bar Radio, where we talk about building wealth, raising capital, and all in all, raising the bar in your business and your life. This is the No BS podcast for capital raisers, investors, and entrepreneurs who are serious about scaling their business and living life on their own terms. I'm Seth Bradley, securities attorney, real estate investor, and entrepreneur, bringing you world-class strategies from the best in the game. If you're ready to raise more capital, close bigger deals, build a better you, and create true financial freedom, you're in the right place. Let's go. All right, let's get into it. This episode has been a long time coming because over the last decade and a half, I've had hundreds of conversations with sponsors, capital partners, independent capital aggregators, who all say the same version, or some version, I should say, of the same thing. Hey, Seth, we're thinking about starting a fund or a syndication, or hey, we already started a fund, but it feels kind of duct taped together. It feels a little bit unprofessional. I don't know exactly what all the pieces are. And almost every time that conversation starts with one big misconception: that starting a fund is mostly paperwork. That once you have your operating agreement, your PPM, your subscription agreement, which are, by the way, very, very important. I am a securities attorney. But once you have that paperwork, that you're basically done, right? And I just want to be very clear right out of the gate that that belief is why so many funds stall, break, or quietly just die during their first raise. Because a fund is not just a legal document. A fund is a system. Just like any business, could be a car wash, could be a gym, it could be a fund. But a fund is a business, and therefore a fund is a system. And today I'm going to walk you through the entire anatomy of a deal, end to end, so you actually understand what it takes to build a real, professional, long-lasting private investment fund. I'm not talking about theory. I'm talking about just raising more money effectively. But we're talking about the actual moving parts, everything you need to put a fund together, not just the legal docs. We're talking about legal. Talking about operational, compliance, administration, your investor experience. Really important. All of it. By the end of this episode, I want you to think, I didn't realize how many things had to work together, how many people or vendors I had to bring in, and why doing this piecemeal actually creates risk. And that's the goal. So whether you're a lead sponsor thinking about launching your first fund, or an ICA, an independent capital aggregator, or a capital partner trying to work with funds professionally, or someone who already has a fund but feels friction all around you, this episode is for you. All right, before we go any further, I do want to take a minute and properly introduce myself because context matters for an episode like this. My name is Seth Bradley. I'm the Chief Legal Officer at TribeVest, and my role there is focused on one thing: building real infrastructure for private market capital raising. Over the last decade and a half, I've worked on and structured more than 700 private investment funds and capital raising vehicles, and I've been involved in over $9 billion in private market transactions across real estate, private equity, alternative assets, you name it. Now, I don't share those numbers just to impress you. I share them to explain how I see the market. When you've seen capital raised at that volume and with that many repetitions, you stop thinking in one-off deals and you start seeing patterns. And you've probably heard that time and time again, but patterns are how you get really, really good. That's how you start seeing the matrix. I start seeing where things consistently break, where risk quietly accumulates, and where structure either protects everyone involved or it doesn't and it gets people in trouble. Now, alongside my role at TribeVest, I'm also the founder of Raise Law, a boutique securities law firm that works with sponsors and fund managers in private markets. And that legal background really matters here because it means I've seen this industry from every angle, not just how funds are supposed to be structured, but how they actually operate once real money and real investors and real liability are involved. And I should also mention that I'm a capital raiser myself, a syndicator, a lead sponsor, a fund manager. I've raised capital in the past. So I come from the business side as well. So multifaceted here. Most people will say, and if you're watching on video, I don't look like your typical attorney either. I don't talk like your typical attorney because I'm not. I'm an entrepreneur just like you. I'm a business person. I love to build. I love to scale. And I think that's why people love working with me, working with TribeVest, working with Raise Law, because we have a very keen sense of business and we aren't trying to block your deal. We're trying to help you scale and build and succeed in your business. So I've represented sponsors on the legal side. I've raised capital myself. I've structured deals from scratch, reviewed deals midstream, and stepped into cleanup situations where things have gone wrong. I've done it all. And that combination of high volume deal exposure plus real operational experience is exactly why TribeVest exists. Not to sell templates, not to add tools you don't need, but to turn capital raising into a structured, professional, repeatable, scalable system. So everything you're about to hear in this episode comes from real life experience, deals that worked, deals that didn't, and the same structural mistakes that I've seen repeated hundreds of times across private markets over and over again. This is practical, right? So if you're serious about raising capital professionally, this context truly matters. All right. Let's start out with what I consider step one, right? Let's define what fund strategy that you want. So before you touch a phone and try to find an attorney, before you open a bank account, or before you even think about getting your documents and filings in place, you need to define your fund strategy. And this is where most people already go wrong because they say things like, we're doing real estate or we're doing fund of funds. That's not a strategy. A real strategy answers very specific questions. And you're going to have to dial this in because when you start talking to investors, if they sense that you aren't confident, if they sense that you aren't competent, they sense that you don't know what you're talking about down to the last detail, unless it's your mom or your sister or your in-laws, then they're not going to invest with you. So get specific, know your terms, know your deal, know your strategy. Things like, what asset class are you targeting? Multifamily, retail, industrial, debt, obviously very popular right now. Fund of funds, obviously very popular right now. If fund of funds, then what types of funds, what types of sponsors, what types of assets are those target deals investing into? What is the geographic focus? National, regional, state, city? Who is your investor? Really think about who your investor avatar is, your ideal client. Are they accredited only, or do you need to work with sophisticated non-accredited investors as well? Are you going to be raising just from friends and family to start, or do you have institutional capital behind you? Think about what's the economic promise that you're making, right? Like, what is the underpinned strategy of your fund or your syndication? Is it cash flow? Is it mainly appreciation? Is it tax efficiency? Is it a major tax strategy for folks to implement? Is it diversification and preservation of capital? What is that economic promise or target that you're going to be pitching to your investors? And here's the key part that people miss a lot. Are you building a closed-end fund or an open-ended fund? Sometimes you'll hear an open-ended vehicle or fund called a rolling fund. And that just means it doesn't have a term, right? It's always going to be open. It's evergreen. Not that it's never going to end. It will end at some point, but there's no predetermined term, as opposed to a closed-end fund where it does have a term. You're saying up front, hey, whenever we sell this one single asset, we acquire it, we sell it, the fund winds up and it's over. Or it's a 5-year term, it's a 7-year term, 10-year term. And then we start winding up all the assets and we close it. That's the difference there. So that decision alone really changes everything downstream. So start thinking about that up front. Again, closed-end funds, they just have defined life cycles, right? Whereas the open-ended funds, they behave more like ongoing capital vehicles that you can consistently and constantly raise into or in tranches. But it changes everything. Your legal documents change, your compliance posture changes, your accounting changes, things get more complex with open rolling funds, your investor expectations change. You need to think about how your investors can actually exit if it's a rolling fund, because you're not going to lock somebody up forever. So you have to think about what that means and the risk that it is to you as the fund manager. But strategy isn't branding and it's not architecture, but every downstream decision, entity structure, banking, compliance, administration, investor relations, it flows from the first step. So if you don't get this right, if you don't get the fund structure dialed in, everything else after that becomes harder. So work on that first. All right, step 2, legal structure and entity formation. This is where we get into kind of the bread and butter of Ray's Law. And also with TribeVest is also an included service as well, just one of the many things that TribeVest offers. But once you have that strategy and it's clear, now we talk about the legal structure, right? We talk about the entity type, we talk about your organizational structure, and this is where people massively underestimate complexity, because a fund is rarely just one entity. At a minimum, you're going to be dealing with the fund or the syndication entity itself, and then possibly a management company. But, depending on the structure that you use, there could be many more. You could have a separate, if you use a limited partnership structure, you're going to have a general partner entity, and then you might have the management entity separate from that. You might have a holding company that holds your GP interest by itself. You may have an upstream parent entity that all of your entities across all your businesses flow up to. So your legal structure matters here, and you really need to have an in-depth conversation with your attorney and also your tax counsel as well, whether that's a CPA or an attorney. So each entity, it has a purpose. Each entity has liability implications, and each entity affects control, compensation, risks. You have at different levels and different entities, you partner with different people, you bring in business partners, you bring in asset managers, folks that help you raise capital, but don't get paid just to raise capital, of course. And you just need to think about where those people will come into play within your organizational structure. So let's talk about the fund entity first. This is typically a limited partnership, or it's an LLC taxed as a partnership. Now, I love to structure mine as LLCs because there's just more flexibility there. I think the old school way to do it would be the limited partnership. Also, if you're having a lot of foreign investors involved, you may want to structure it as a limited partnership for their tax strategies. But this is where the investor capital actually lives. This is where you're raising into. So this entity needs an operating agreement or a limited partnership agreement, clear economics, waterfall, fees, clear governance, voting rights, management rights, clear capital mechanics. And then, that's really the main entity that we really need to focus on. And it's largely the focus of your PPM, right? You're disclosing everything. In the PPM, you're basically disclosing all the things in plain English, or it should be at least, that are part of the operating agreement. So think about that, how you want to structure that, all the mechanics of voting, management, membership classes, fees, all those things are going to be contained here at this entity level. And then you have your, some people say GP, right? Or you have your manager. If it's an LLC at the fund level, then you'll have a managing member, or you'll just have a manager depending on how that LLC is set up. Or if you're set up as a limited partnership at the fund level, then you'll have a general partner which will also be, it should be an LLC so you can protect yourself from liability there. But we'll call it a GP for now. The GP actually controls the fund entity. This is where the decision-making authority lives. And how you structure that GP determines who actually controls the fund or the syndicate, how the promote is allocated, how the future partners are added or removed. And then you have, and this can also be the management company, and it typically is. So it's where the fees are going to flow. So if you charge an upfront fee, an annual fee, or any of the myriad of other things that you can charge, those fees flow to this group or to this entity. So, after mixing these entities incorrectly, or if you mix these entities incorrectly, you can create lots of tax issues, lots of liability issues, which is my main concern, and governance nightmares, right? Like, what if you have to just do something simple like fix an error, or amend your operating agreement? Does that take an entire vote of all of your existing investors? Or if it doesn't affect them, then you can just unilaterally do that as the GP or the manager. So really start thinking about that, making sure that you understand how your entities operate, and speak to your attorneys about that. This is also where people try to cut corners, right? They'll say, can't we just use one entity for everything? Can't we just keep it simple? Sure, you can. You can keep it simple. And I always like to keep things simple. I definitely do not like to organize entities to make it this intricate, crazy organizational structure. But you definitely need to have the bare minimum. And a lot of times, especially when you're dealing with limited partnerships, you need to be very careful about liability and creating enough separation between you as an individual and you as the manager of a fund or syndication. So structure protects everyone involved, though. It's not just you as the fund manager or the syndicator or the lead sponsor. It also protects your investors, obviously, and you want to make sure that you have alignment there. So your investors, your business partners, of course, if you have any, and your future self, right? Like, you want to protect yourself and your business. So fund formation, it's not about being fancy and trying to be cutting edge, but it is about being intentional and knowing that you are protected on the legal side from liability, both from an individual standpoint as the fund manager and at the property level if you're dealing with those types of assets. Pardon the interruption, but we don't do ads. Instead, know that if you're raising capital for real estate, my law firm, Raise Law, is here to give you the expert legal guidance you need to raise capital compliantly and structure and close your deal. And if you're looking for a done-for-you fund-to-fund solution, TribeVest is the industry's only all-in-one setup and fund administration solution. Visit raise.law and tribevest.com to learn more. All right. 3, let's talk about compliance and regulatory considerations. This is where things get uncomfortable for people because compliance doesn't necessarily feel productive. It's not sexy, right? It's not actually raising money. It's not marketing or putting your pitch deck together or going on podcasts or speaking in front of rooms of investors. It doesn't close deals by itself necessarily, but it absolutely determines whether your fund survives long term. And at a high level, every fundraise is a securities offering. And that means securities laws apply. So investor eligibility matters, accredited versus non-accredited. How you market matters, whether you're allowed to solicit, advertise, talk about your deal openly to the public or not. How you communicate matters. If you're guaranteeing things, if you're promising things, should not be. If you're raising under Reg D, you really need to have a deep understanding, I shouldn't say a deep understanding. You need to have a surface level understanding of what exemption you're going to use to succeed. There are others, even outside of Reg D, but typically, that's where we operate. Reg D, there's also Reg A, there's Reg CF. There's other ways to do this, but really for you, have a good understanding of 506B versus 506C, and there's all kinds of content out there, including on the Best Ever podcast here. There's been plenty of awesome securities attorneys and folks talk about that, so look that up. Have a good understanding of that so that when you do speak to your securities attorney, you can make an informed decision and help decide how you want to structure your deal together. Another thing to think about, are you verifying accreditation or not? Again, it comes back to that 506B versus 506C exemption that you're going to use. Now, if you're dealing with other capital partners, right, not necessarily internal ones, you really need to understand who is being compensated for what, how they're being compensated, and for what they're being compensated for. Because let's not beat around the bush here. It is illegal to raise capital without a license or without an exemption. Let me say that again. It is illegal to raise capital without a license or without an exemption. Just like I'm an attorney, or just like your doctor or your dentist, you have to have a license to practice whatever it is you're practicing. And in this instance, it's raising capital. You have to have a license to raise capital. You have to be a broker dealer, right? Or in some instances, you can be an RIA and things like that, or an ERA, but you have to have a license or an exemption. Now, do we want to necessarily be licensed? We sure don't. Lots of red tape, lots of things that we have to abide by that we don't want to deal with FINRA and the SEC. We don't want that. So we operate in the world of exemptions, right? And we already talked about kind of 506B versus 506C. That puts limitations on you. If you are the issuer, meaning the person or the entity that is actually raising capital for your own deal, then that in itself is a way that you can do things, but you still can't get paid just to raise capital. You're setting up your fees, you're setting up your promote or your carried interest, whatever you want to call it, such that you're not getting paid just to raise capital. You're getting paid to do your deal, right? You're getting paid for your sweat equity, which does include raising capital, but it can't be based on that. It's based on all the things that you do: due diligence, investor relations, which that one gets abused, asset management, all the many things that you do as a capital raiser for your own deal. That's what you get paid to do, not for just raising capital, because you have to have a license for that. So when you bring in other capital partners, there are lots of landmines that you can step in. This is where the mistakes get really expensive, and not theoretically expensive. And it's not like I'm threatening, hey, if you don't do it right, you're going to go to jail. Probably not. You're probably not going to go to jail unless there's some serious intent there. You can easily get fined to the point of what we call a bet the farm type of instance, where your business is over. You need to pay back your investors plus interest, plus maybe you won't be allowed to raise capital for a while if there's any sort of intent there. And that kills your business. So it's really expensive. Imagine if you raise $1 million and 3 years later, the deal goes bad and it's found that you raised capital illegally. Well, now you got to pay that $1 million back to your investors, and it doesn't come from the return of the capital from the deal, because probably what happened is the deal went bad. The investor gets pissed and they talk to the SEC or the state commissioner and they're coming after you. So there's no money to be paid back. So that's coming out of your pocket at that point, right? So you've got to pay $1 million plus interest back to the investors. And that's a major, major problem for you, because most of you out there probably don't have insurance for this either. You should look into that. That is something that exists, but most of you don't have that. So you're in trouble, right? So real expensive fines, rescission rights, interest, investor disputes. Compliance is the new currency, as we like to say here at TribeVest. The better structured you are, the easier it is to raise capital repeatedly and compliantly. All right, let's pause here for a second, because the reason I'm spending time on this isn't to scare you, it's to show you where this industry is headed. Private market capital raising has outgrown informal improvised systems, and as more lead sponsors and capital partners enter the market, the industry needs shared standards, real structure, and professional frameworks. And that's exactly why TribeVest launched the Institute for Structured Capital, or the ISC. It's a limited cohort-based program designed for people who are serious about raising capital the right way. Not just getting a deal done, but building something durable. There are 2 tracks, one for lead sponsors who want to build a structured program around working with capital partners, and one for capital partners who want to build a real capital aggregation business professionally, compliantly, and at scale. I'll come back to this at the end, but if this conversation is already hitting close to home, you can check it out and join the waitlist at tribevestisc.com. All right. Back to the anatomy of a deal. Let's jump into step 4, banking, capital flow, and administration. And this is where a lot of funds really feel the pain, because this is where theory meets reality. Subscriptions, capital calls, distributions, accounting, K1, all this stuff. If these systems aren't clean, everything slows down and investors start losing confidence in what you're doing. They get frustrated. Sponsors get buried in emails, mistakes compound, and capital flow needs to be intentional. Where does the money come from? How is it tracked? How are allocations calculated? Who reconciles the accounts? Who prepares the tax documents? This is not optional work. You have to do this, and you have to figure out how to do this professionally and compliantly. Now, think about in the past, like how we used to do this in the industry. You know, we use this co-GP model that really got abused in the past, right? We're entrepreneurs and we tend to really push the cards. We tend to say, okay, give us a little bit and we're gonna take that and then we're gonna push it a little bit more. And that's what we did with the co-GP model. You know, after the Jobs Act of 2012, basically we said, hey, you know, we can get outside of these country club types of deals. And, you know, you saw this explosion of people that were partnering together, raising capital, buying assets, starting funds, doing all these things. And that's great. That's the whole point of that. That's what we wanted to do. We wanted to bring the private markets to more investors to get access to these awesome deals that didn't used to be accessible to people. But that came with the caveat that, well, we started putting together these quote unquote co-GP groups where you had, you know, 5, 10, 15, 20 people together buying a single asset and saying that, you know, they're all partners together as active partners buying, let's say, in a multifamily apartment building or raising $1 million into a fund to fund. And at the end of the day, does it really take that many people to operate one of those? It doesn't, because you're going to hire a property manager to do all these things. And what are these people getting paid to do? Are they getting paid to provide asset management? Are they getting paid to actually manage and vote and do the things that active partners do? Well, the answer is no, they're not. They got brought in to raise capital. They got brought in for their small investor base so that they can bring in an extra couple $100,000 or $500,000 or $1 million and then walk away from the deal without actually doing anything. And again, guess what? You have to be licensed to raise capital. This co-GP nomenclature really has a negative connotation to it nowadays, but that co-GP model, it's dead. You just can't do it, especially when a lot of times people weren't just getting paid to raise capital. And when I say getting paid, I mean not just fees, but equity. You can't get paid equity either. But they were getting paid based on how much they actually raised. And that's transaction or commission-based compensation for raising capital. And that is totally non-compliant, illegal. But luckily, you know, all these deals have went fantastic up until about 2022, and no investors were really mad, so they weren't suing, so nobody was really getting in trouble. But at the end of the day, non-compliant, we've moved on. We figured out that, hey, we need to find another way. And typically the way that people are doing it now is fund of funds, right? That's what TribeVest does. That's what some other folks do. So we do a fund of funds. But the problem with the fund of funds is that whereas with the co-GP, your lead sponsors did everything for you, right? You got to use their investor portal. You used their accountant to do K1s. They did the distributions. They had an investor onboarding team for you. They drafted the offering documents through their securities attorney. They did everything for you. With the fund to fund, there's a level of separation there where the fund manager has to do all of those things that the lead sponsor used to do for them. So that's problematic, but that's why companies like TribeVest exist, is because we do all those things for you or with you, or you need a piecemeal kind of a team together where you get a securities attorney, a CPA, an investor board, and all those things and those pieces that you need. But all of this is not optional work. When it's done manually, it becomes a full-time job. If you're managing this just on a spreadsheet, it's a problem. It's not professional, and investors get very weary of that very fast. So you really need to start putting those pieces together, the softwares, the team members, the vendors, whatever that looks like for you. Step 5, we kind of touched on this, but the investor experience in ongoing operations. So here's the truth that most sponsors don't want to hear. Investor experience compounds. And what I mean by that is professional communication, consistent communication. It builds trust. Transparency reduces friction. Clear reporting, consistent reporting keeps investors long-term. It keeps them coming back to invest in your next deal and the deal after that and tell their friends about your next deal and the deal after that. But on the other side, inconsistency or non-transparency or not communicating with your investors at all kills their confidence. And guess what? They won't come back. It doesn't matter if the deal went well or not. They're not going to keep investing with you because they just don't believe in it. Because if all your communication is just to get their $50,000 or their $100,000 through the door, and then you don't talk to them again, confidence is over. They're not referring you to other investors. They're not referring you to friends and family. And just remember that your LPs are always evaluating you constantly. They're watching, they're listening, and it's an emotional thing. So you have to present professionally. Updates can't be late, documents can't be scattered, can't be that frustration from your investors. Reporting can't feel sloppy. They notice these things, even if they don't say anything. So you'll know it. Now here's where things break without structure. And this is the pattern that I see over and over. You've got too many vendors. You have investor portal hopping, so to speak. Too many logins, too many spreadsheets, manual processes everywhere. It wears on your investors and it wears on you. Fund founders, you guys burn out. Capital raising gets slowed down, not because the deals are bad, but because the system is just fragmented across different portals, different softwares, manually done on spreadsheets, different vendors, changing attorneys, changing CPAs. The system's just fragmented. And that complexity just compounds when systems are fragmented like that. So we need to find an integrated solution. And that's why integrated infrastructure exists at all. Not because you can't do this as a fund manager or a lead sponsor, but because doing it in pieces, it creates risks, it creates holes, it creates opportunities for problems to arise or for inconsistencies. Capital raising is a project. It's not a task. It's not a one-time check the box thing. When legal and compliance, banking, administration, the investor experience live in one system, the friction starts to disappear. And look, this is why the market moved towards an integrated infrastructure. Not because sponsors or fund managers can't do this, but because doing it in pieces creates risk. And here's the line I want to leave you with. The problem isn't that you can't build a fund. It's that you're forced to build it in fragments, and that creates problems. That's why TribeVest exists, to turn fund formation into a capital raising project, not a guessing game. Capital raising in the private markets is no longer a side skill. It's something that needs focus, and it deserves focus. It's not something you can improvise your way through with spreadsheets and manual integrations, emails, and really just good intentions. It's become a profession. And if you want to compete out there for investor capital that's smarter, that's more intelligent now, that's got battle scars, you have to be professional. And professional requires structure, standards, and frameworks. And that's why TribeVest launched the Institute for Structured Capital. It's a selective, cohort-based experience designed for people who want to raise capital with credibility. There are 2 tracks inside the Institute, one for lead sponsors who want to build a structured, repeatable program for working with capital partners, and one for capital partners who want to build a legitimate capital aggregation business the right way. This program runs for about 8 weeks and includes live sessions, peer cohorts, and experienced coaches who have actually done this in the real world. If you're serious about raising capital at scale with structure and compliance and really long-term credibility and professionalism, you can join the wait list at trivestisc.com. And if this episode helped you see the gaps more clearly, share it with someone who's thinking about starting a fund and hasn't yet realized how many moving parts are involved. All right, it's been an absolute honor hosting the best ever CRE podcast. Keep raising the bar. I'll see you on the next one. Thanks for tuning in to Raise the Bar Radio. If you enjoyed today's episode, make sure to subscribe, leave a review, and share it with someone who needs to hear it. Keep pushing, keep building, and keep raising the bar. Until next time, enjoy the journey.